In a stunning turn of events, Wall Street's profit forecasts have surged, raising alarms about a potential earnings bubble. As analysts project unprecedented growth, the stakes for investors have never been higher. Here's everything you need to know about today's shocking market developments. Looking ahead, the coming days will be critical for investors as several key events could shape the market's trajectory. On Wednesday, the release of the Federal Reserve's meeting minutes will provide insights into future interest rate policy, which could significantly impact valuation models across various sectors. The Fed's stance on interest rates is particularly pivotal given the current economic climate, where inflation continues to be a concern. Recent data indicates that inflation rates remain stubbornly high, prompting the Fed to carefully consider its next moves. Investors are keenly aware that any hints of tightening monetary policy could lead to increased borrowing costs, affecting everything from consumer spending to corporate investment. Additionally, the earnings season is set to kick off, with major companies like Delta expected to report their results. These reports will be crucial in determining whether businesses can meet the inflated forecasts that have been set amid a recovering economy, particularly as supply chain issues and labor shortages persist. Furthermore, Thursday will bring fresh job data, offering additional perspective on labor market stability and inflationary pressures. If earnings reports disappoint or if AI growth slows, the fears of an earnings bubble could trigger a market pullback, particularly within the tech sector, which has seen unprecedented growth and valuation increases in recent months. Investors will need to remain vigilant and adaptive as the landscape evolves. The interplay between corporate performance and economic indicators will be essential in shaping market sentiment. As we consider the potential volatility ahead, a pressing question emerges. How will investors adjust their strategies in response to these unfolding events? With uncertainty looming, proactive adjustments could be crucial for capital preservation and growth. As the week progresses, attention will center on how these developments influence market confidence and the strategies investors implement to navigate this increasingly complex economic environment. The current situation on Wall Street did not develop overnight. It is the result of a series of significant events leading up to today. The past few years have witnessed an unprecedented AI boom that has fundamentally transformed corporate earnings across various sectors. Industries such as chip manufacturing, cloud services, and software development have reaped substantial benefits from this technological revolution. The first half of 2026 has been particularly noteworthy, with the Nasdaq experiencing its strongest performance in U.S. exchange history, raising an astonishing $129.3 billion from new listings. Companies like SpaceX have emerged as leaders in this charge, showcasing the growing confidence in AI-driven innovations that are reshaping our economy. This rapid advancement in technology has not only created new markets, but has also disrupted traditional business models, compelling established firms to adapt or risk obsolescence. Adding to this momentum, the U.S. economy has demonstrated remarkable resilience, posting an annual growth rate of 2.1% in the first quarter, which exceeded previous expectations. This economic growth, coupled with a stable labor market, has further bolstered corporate confidence. The June job report revealed modest hiring of 57,000 jobs, while the unemployment rate fell to 4.2%, indicating stable labor conditions that can support continued growth. However, this reliance on AI as a primary driver of growth raises concerns about sustainability. Analysts warn that if these optimistic projections do not align with actual market performance, we could see significant corrections. The potential volatility in AI stocks and the overall market could pose risks for investors, particularly if economic conditions shift. As we look to the future, ensuring that the growth driven by AI remains robust and sustainable is crucial, as it will determine the long-term stability of financial markets and economic prosperity. The implications of these surging profit forecasts are profound and immediate. Recent reports indicate that numerous companies, particularly in the technology sector, are projecting significant earnings growth fueled by advancements in artificial intelligence. Investors are now facing potential valuation risks, especially if this anticipated earnings growth fails to materialize. Such a scenario could lead to sharp corrections in stock prices, particularly in sectors heavily reliant on technology and AI. The fear of an earnings bubble also introduces heightened volatility into the market, prompting some investors to shift their portfolios from high-growth stocks into more defensive assets, seeking to mitigate risk. The optimism surrounding AI is compelling, yet it is precariously balanced on the assumption that productivity and revenue growth can be sustained over the long term. Many analysts argue that while AI has the potential to revolutionize industries, the current valuations may not accurately reflect the underlying economic realities. For the average investor, this situation is particularly critical. It poses the risk of significant financial loss if these inflated expectations do not align with reality. Furthermore, as the market navigates through this uncertainty, the performance of key companies during the upcoming earnings season will be pivotal in shaping market sentiment. The stakes are high, as a failure to meet these optimistic forecasts could result in a broad market sell-off, affecting not only tech stocks but also the overall economy. A downturn could have a cascading effect on consumer confidence and spending, which are vital for economic growth. On the other hand, if companies exceed expectations, it could provide a much-needed boost to investor sentiment and stabilize the market. Looking ahead, the upcoming earnings reports from major players in the AI space will serve as a litmus test for the sustainability of this growth narrative. Investors will closely monitor these results, as they will likely dictate market trends and investor behavior in the months to come. In this environment of uncertainty, making informed investment decisions will be crucial as the landscape continues to evolve. The next few weeks will be key in determining whether the current optimism is justified or if a correction is imminent. Today, July 7, 2026, Wall Street analysts reported a dramatic increase in earnings forecasts for the S&P 500, marking the fastest growth rate since the post-COVID rebound. Analysts attribute this surge to remarkable AI-driven revenue gains and robust corporate performance during the first half of 2026. The revised projections now suggest that S&P 500 earnings could grow at an unprecedented pace, creating a scenario where stock valuations may be severely disconnected from realistic fundamentals. This situation raises critical questions about the sustainability of such extraordinary growth. In recent months, the business landscape has been reshaped by advancements in artificial intelligence, influencing sectors from healthcare to finance. Tech giants like Google and Microsoft have reported extraordinary revenue increases, largely due to their investments in AI technologies. These companies are not only enhancing operational efficiencies, but also creating entirely new business models that capitalize on AI's capabilities. As a result, the enthusiasm around these innovations has fueled a surge in stock prices, leading to heightened market activity. However, analysts are now warning of a potential earnings bubble, a term that refers to the risk of inflated stock prices not being supported by actual earnings growth. This phenomenon is particularly alarming given recent market trends, where the enthusiasm for AI and technology stocks has led to skyrocketing valuations. The stark difference from prior market cycles lies in the intensity and speed of these earnings forecasts, fueled by the AI boom rather than traditional economic indicators. The rapid pace of earnings growth contrasts sharply with the cautious optimism that typically characterizes sustainable market expansion. As the market reacts, investors are left to ponder the sustainability of such rapid growth amidst concerns of overvaluation. The implications of this earnings surge could be profound, potentially leading to increased volatility in the stock market. If the anticipated earnings do not materialize, a sharp correction could ensue, impacting not just tech stocks but the broader market as well. Looking ahead, investors must consider the balance between innovation-driven growth and the realities of valuation metrics. The coming months will be critical in determining whether this AI-fueled optimism will translate into lasting economic benefits or whether it will result in a market recalibration. As we move forward, how will investors adjust their strategies in light of these unfolding events? Share your predictions in the comments, and don't forget to subscribe for daily deep dives into the world of finance.